Good morning, everybody. I'm your host, David Leary. Thanks for attending this special webinar on March 22nd, 2018. Webinar is Funding for QuickBooks Developers. We have two special guests here. They're from Lighter Capital. Lighter Capital is doing revenue-based financing for developers, and there's a special $15 million fund just for QuickBooks developers. So our two special guests today, we have Alan Johnson. He's the managing director at Lighter Capital. And our other special guest is Thomas Malcolm. He's the Lighter Capital's Director of Strategic Partnerships. I'm going to, if they want to unmute, it looks like you're unmuted. If you want to give a wave, Alan and Tom, that'd be great. And I'm going to stop sharing so you guys can go ahead and share, and we're doing the logistics on the stopping sharing. I just want to remind everybody that's attending, please use the Q&A panel for any questions you have during today's webinar. And at the end, during the Q&A session, we'll cover all those for you. So without further ado, I'll hand it off to you, Alan and Tom.
Great. Thank you so much, David. I appreciate you, everyone that is in attendance today to take time away from your busy schedules and learn more about the $15 million fund that Lighter Capital and Intuit created at the end of last year. Many of you may be aware that we announced it right around QuickBooks Connect last year, and are really excited about the opportunity to support Intuit developers, and really love working with Intuit. Working with Intuit in terms of the support that they've provided for the developers and in creating this fund as well. So as David noted, we'll kind of high level talk about revenue-based financing and what that can mean for you and your business as it relates to obtaining capital to continue to grow and scale. For any of you that have gone through the process of finding growth capital, you really know that there's a funding gap for early stage tech companies. When it comes to obtaining that growth capital. Really, kind of the earlier stages, you're looking at friends and family, as well as angel investors. But a lot of times they can't provide enough capital to really scale a business. They can get it off the ground, maybe provide that initial seed funding, but anything beyond that becomes difficult and time consuming. So it's not necessarily the best option long term. Banks, while cost of capital is cheap and can provide working capital facilities and a lot of other products, really they can't get comfortable with earlier stage companies, and especially tech, because there's no collateral. Often they are not profitable, so there's not a lot in terms of assets that they can get comfortable with, and so it's not necessarily the best funding option for earlier stage companies. Which leaves us with VCs, and obviously venture capitalists have a huge mind share in the media and the companies that they've funded, and the millions of dollars, billions of dollars that they've provided to tech companies. But the reality is they're looking for hyper growth companies that will result in a sizable exit. And not everybody wants to become a unicorn or has visions or that's really what they want for their company. They want to build a great company, a lifestyle business, and potentially sell it at some point, but it doesn't have to be the unicorn that VCs are looking for. Harvard Business Review did a study that fewer than 1% of startups raise capital from VCs. Obviously in the tech community that's a little bit greater. But at the end of the day, it's a very small percentage of the overall capital markets and where people are, how they're growing their companies. So the solution is, from our perspective, as well as Intuit, is really the Lighter Capital and Intuit Developer Fund, the $15 million that we announced last year. With this, the individual companies can have access up to $2 million of growth capital, which allows you to focus on building your business and not going through the pain of raising capital, be it from angels, VCs, banks, and so forth. And so you're really focusing on growing the business. And the great thing about the revenue-based Lighter Capital revenue-based model is that you retain equity and control throughout the process, and there's no dilution in terms with our offering. As well as you have a community of like-minded entrepreneurs. So as it relates to the Intuit fund, right? There's a number of other Intuit developers in there, and we'll work in conjunction with Annie and Alex, connecting those entrepreneurs and helping where we can. One of the companies that we've funded as way of the fund is Notify. As you can see from this quote from Dan, he really got the value of Lighter Capital and the fact that how precious their time is, and the time spent with investors and not engaging with customers and building a product really can hinder the growth of a business. And Dan's comment and quote is really pertinent because we see it time and time again that when growth of companies stall out because of the time it takes to fundraise. Just to give you a couple more highlights on Lighter Capital. So the company was founded in 2010. We're based in Seattle. We fund companies across the country. We've funded over 250 companies across 400 rounds of financing across nearly 30 states in the U.S. So we're agnostic to kind of where you are, other than some state regulations. And in doing so, we've deployed over $100 million to early stage tech companies, and have really, seen the benefit of our financing as by way of exits and future equity raised and so forth. So it's exciting for us to have eclipsed the $100 million mark, and now partnering with Intuit, we look to continue that growth. So where does Lighter Capital fit in terms of when you're comparing other capital sources? On the more traditional side of things, you have bank debt, and then on the more hyper growth, the side of things, you have venture capitalists. We really believe that we sit in the middle of those when you compare our offering. So I won't go into the specifics of all of these, but on a high level, on the bank side of it, equity dilution is a big thing for entrepreneurs. And in our offering, there is no equity dilution. There's no equity kickers. There's no warrant coverage. Whereas obviously on the venture capital side thing, you're looking at traditionally 20 to 30% dilution per round, not taking into any account any of the option pool refreshes. If on the other side you have bank debt, it may be venture. If you have venture debt coming from banks, there may be some type of dilution, but typically it's very limited by way of warrant coverage. On the control side of thing, which we find is very important to our entrepreneurs as those raising money, obviously in the subsequent rounds, it's very easy to get below that 50% mark and lose control of the company. And so with our offering, there is, again, because there is no dilution and there's no control mechanisms in place, it's really your company. We believe we're investing in the company you built, and you should continue to operate it as such. So, and how it's evidenced by no personal guarantees, no financial covenants, and no board representation. So on the personal guarantee side, you're taking a risk at your company with starting this company, and therefore we don't believe that you should have to put your house and family on the line if things were to not work out as planned. Separately, financial covenants are a way for banks to really restrict growth of companies, whether it's a matter of maintaining liquidity ratios or growth ratios or profitability ratios. It doesn't allow you to operate the company for growth, but rather you're operating the company to make sure that you stay in compliance with the covenants, and therefore don't end up in a default. And on the board representation side, if you're going down the equity path, obviously that's a huge value add in terms of their representation and guidance. Whereas on the bank side of things, there's not going to be that value. With Lighter Capital side, we don't believe we have no representation, observation, or anything else. Again, we're believing in the company that you've built, and will continue to scale. Our product is a debt product, and as you'll see later, it's a matter of financial. It's a percentage of your monthly net cash receipts as how we're repaid. So when you talk about payment flexibility, traditional debt is just level principal and interest payments once that starts amortizing. So that, depending upon the cyclicality of your business, that can be very restrictive and potentially choke out the company in certain periods throughout the year. On the other side, from the equity, obviously you've given away 20-30% equity in your business, and so there are no payments. The payments are by way of the future exit and then getting their returns. Whereas Lighter Capital, as I noted, our payments are based on a percentage of your monthly net cash receipts. So in stronger months, you'll pay us a little bit more. In weaker months, you'll pay us less, and it can fluctuate throughout the year. And as noted by the comment before, really the speed is really where we differentiate. And so because of the technology behind our business, we're able to underwrite and get through processes on average in about 4 to 6 weeks. That being said, we've done initial fundings in as little as 15 days. As you see later, we can provide subsequent rounds of funding up to that $2 million. So those future rounds of funding can take as little as 1 week out the door. So again, keeping you focused on the business matters at hand. So what's the type of company that where do we fit in terms of the life cycle of business? Really, we kind of range in the kind of the bootstrapper, kind of maybe post-seed, if there is equity, to kind of the Series A, and in that range there. We have funded companies that are post-Series A that have stalled out a little bit, but most of the time, this is kind of we're in that bootstrapper C to A range. And really, we're agnostic to the cap structure of a business. If a company, if it's an entrepreneur that has had multiple companies before, has seen the perils, experienced the perils of raising equity, losing control of the business and whatnot, and really they just want to bootstrap and build a great lifestyle business, that's awesome. We can help there and help provide that growth capital. Alternatively, if there are equity investors on the seed side or the A side, we can slide in to help fuel the growth of the business, so that on that subsequent round, the dilution factor is that much less, and so really you can kind of kick the can down and increase the valuation. On average, so looking at our portfolio, our current portfolio, the average customer profile is they have annual revenues of about $1.8 million. They are burning to the tune of about call it 12,000. So they are not profitable per se. And as well as the growth rates in the 50% range on average, but that ranges upwards of, in some cases, 100% growth, whereas some are on the lower end of that. So obviously, so we're not looking for hyper growth companies as many equity investors would. We just want to see companies that are growing, and we want to continue to help fuel that growth. So I'm going to get into a little bit of the specifics now about Lighter Capital and revenue-based financing. So we view ourselves as a long-term capital provider. So kind of going back to the previous slides around bank versus venture capital, a lot of times people will compare Lighter Capital to a line of credit offered by an SVB or a Square One or take your pick. That we don't see that as necessarily an equivalent competitive marking, if you will. So that's working capital facility, which needs to be cleaned up every year. It should be used for those short-term capital needs. Whereas Lighter Capital is more of a growth capital debt facility. So you're looking at longer term. So again, our facilities are structured with a term of 3 to 5 years. How we determine how much we can provide is it's a multiple of your monthly revenue. So that initial tranche size can range anywhere from 50 to 500,000. And as the company grows, we can continue to provide capital and put more capital out the door, up to $2 million. So how do we determine that 50 to 500? That, like I previously noted, that's based on a multiple of monthly revenue. And the range is dictated by way of the term. So on a 3-year facility, we can lend up to 3 times that monthly revenue, whereas on a 5-year facility, we can lend up to 4 times. And I'll provide an example in a minute here, so you'll kind of clarify a lot of this. How Lighter Capital makes our returns. So we, unlike equity investors that are trying to get 7 to 10x returns, we cap our returns. And depending upon the risk profile of the business, as well as the term of the facility, that can range anywhere from 1.35 to 2 times the principal amount. How we get repaid then, as I noted earlier, it is a debt facility, so we are expecting to be repaid. And how we're repaid is by way of a monthly royalty rate of your monthly net cash receipts. On average, that royalty rate for the portfolio is right around 7%, but it will range between 1 to 10% of the monthly NCRs, never to exceed 10%. The great thing about those, as I noted, because of the royalty rate as a percentage of monthly net cash receipts, in stronger months we get paid more, in weaker months we get paid less. And so if your royalty rate is 5%, and in a month you're doing 100,000, you would pay us $5,000. Next month you increase to 200,000, and we would get paid 10,000. And so forth and so on. So there might be those months, if you think about an a gov tech or an ed tech, it works really well with those models because of the cyclical nature of the budgeting and when payments are received. before I move on, it's important to know too, this is not in perpetuity. Once the principal plus repayment cap have been repaid, then the obligation is ended and we're no longer part of the company. So what kind of, why do people come to Lighter Capital? Where are they using the money? Really, it's about revenue generating uses, right? So whether it's hiring marketing people, sales people, engineers to build out the product, customer success to reduce churn, or maybe there's the engineers, you're looking to do new product development, right? That we can help fuel that. A lot of times we see the customer acquisition in terms of fueling the paid marketing strategy, bringing awareness to the brand at trade shows, events, so forth and so on. As well as you may have made the investment in the business and the burn is a little bit higher, and you need help kind of covering some of that shortfall, or just kind of that interim piece as you continue to scale, and we can kind of slide in there as well. Agile Iron is another company that we funded under within the fund, and as you can see from Satish's comment, they needed money to grow quickly, and they've now come back for a second facility from us, and we'd love to see continue to fuel the growth of that company. But again, we can operate quickly as well as helping. We don't restrict the use of funds, so as if you can deploy the capital where you see fit, and really. Go back to, again, you built this business. We just want to help grow it. So what are the types of companies we're looking for? Typically, the foundation of what we're really looking for is a reoccurring, predictable revenue or reoccurring revenue. So while a SaaS business is the kind of the perfect center cut company, we've funded numerous companies that aren't perfectly, don't have that subscription base, but have a repeatable revenue stream, whether it's from payment processing or so forth. We can get comfortable with those types of companies. We are looking for tech companies, be it SaaS, software, tech-enabled, managed services, and so forth. We don't get outside of the tech space. As I noted earlier in the presentation, we are looking for companies that are growing. They don't have to be hyper growth companies, but we do want to see that they're at least increasing, at minimum not decreasing in terms of their revenue. Because of the royalty rate nature of our offering and the repayment, we want to see gross margins over 50%. That allows us to that payment to be made without cutting to the bone, as well as allows us, the company, if there's ever a hardship in the company with the reoccurring revenue nature plus then higher gross margins, there's a lot of runway to be able to kind of work out of any problems. We don't necessarily, as you saw earlier, we do fund companies that are burning. They do not have to be profitable. That being said, we want to see it be less than 50% of the monthly gross revenue. So for example, if a company is doing $100,000 a month, we don't want to see that their expense structure is more than $150,000 per month. From a churn perspective, there's no specifics. We have guidelines, but we just don't want to see high, we want to see low client loss. Again, that goes back to the predictability of the revenue and our ability to get repaid, and the company's company in perpetuity. So, and again, you can get into logo churn versus revenue churn, net churn versus gross churn. But at the end of the day, we're happy to talk through it with you, and see where we slide in. We don't want to see a lot of concentration in customers and or contracts. So whether there's few customers or you have 10 customers, but one represents 90% of your revenue, probably not the best fit. Only because if that one customer is lost, then the company really is it's a different picture of the company. So ideally, you have multiple customers and not a whole lot of concentration from the revenue side. We do want to see companies that are either based in the United States or have a subsidiary in the United States. So we've funded companies that are based internationally. We're not as concerned about the IP as equity investors might be, but we do need to see that there's revenue running through U.S. bank accounts. Again, going back to our model, needing to be repaid, we would be repaid on the revenues running through those U.S. bank accounts to determine what those net cash receipts are. So if you have international business, if you're based internationally, but you have a good portion of it running through the US, we should absolutely talk. And then from an existing debt side of things, we have standing intercreditor and treaty agreements with the major financial institutions, SVB, Square One, so forth. So we will subordinate to them. If you have a line of credit outstanding, we're happy to subordinate. Whereas, if you have venture debt on the balance sheet, we won't subordinate to them. Or MCA debt is another one that if you have something from Cabbage or Blue Vine or so forth, we can always look at taking that out, but we will not subordinate to those institutions. So here's putting kind of all of it into context in an example. So we'll just say this is a pretty center cut deal in the SaaS business, high levels of recurring revenue, low churn, so forth and so on. We'll make it, numbers are easy here, and that they're doing $100K a month. So their annual revenue is about 1.2 million. Given that obviously the longer the term, the more money we can put out the door. It's a matter of the profile of the company if we're willing to do a 3, 4, 5 year facility. In this case, we say it's a 5-year facility, so we can put the maximum amount of money out the door. So at $100,000 a month average revenue, at four times multiple, the initial tranche size is $400,000. Based on the profile of the company, we determined that a repayment cap is of 1.7x. So the 400,000 times the 1.7 gets you to the $680,000. So that's the amount that will be repaid to Lighter Capital over a period of 5 years. Sometimes it's less, sometimes it's more. And we can chat about that a little bit. And that's comprised of 400,000 in principal and the interest expense of 280,000. How we're repaid is by way of that royalty rate of the monthly net cash receipts. So in this example, the royalty rate was 7.5% of net cash receipts up to the 1.2 million in that respective year. So if the company does 1.2 million, Lighter Capital would receive $90,000 in that year. You see the tier 2 royalty rate. The reason that we structure facilities with tiers is because quite often the entrepreneurs feel that, and for good reason, feel that the growth rates are going to be significantly higher than maybe historical, or maybe or from a debt provider perspective, how comfortable we are. So if a company is doing 40% a year and year-over-year growth rate, and they're saying, but I expect to do 100%, that's difficult for Lighter Capital to get comfortable with, and making those assumptions that 100% is going to happen. So how we mitigate that is by way of adding in additional royalty rate tiers. So in this situation, anything over that $1.2 million of revenue or net cash receipts would be subject to a 4% royalty rate. And a lot of times we've done 3 tiers, so the last tier might be less than 1%. So again, the idea of it is to help the entrepreneur feel comfortable that they're not going to repay Lighter Capital too early, and that they'll be able to continue to keep cash in the business and grow. On that note, the ideal situation for Lighter Capital is we structure these facilities such that the maturity date, you land right around the maturity date of the call, that 5 years. Given the variable nature of the payments and the inability to predict 5 years out, it's very, there's going to be times when we're repaid early or we're repaid later. And so obviously the idea, but again, by structuring the royalty rates in the tiers, the idea is hopefully we land as close as possible to that the term maturity date. It's important to note that, because of those subsequent rounds that we can do, as noted with Agile Iron, we're on our second facility. Each time that we look at a facility, we kind of true up all of the profile of the offering. So the repayment cap can be adjusted, the royalty rates can be adjusted. So we kind of always keep dialing it in to make sure that we're connected with the entrepreneurs, with the growth as well as expectations. So the next couple of slides are just going to show the value of Lighter Capital on the entrepreneur's equity as well as control. And as I noted, we're really agnostic to if there is equity, if there's equity investors in the business when you come to Lighter Capital, or if you're looking to raise equity subsequent to the Lighter Capital facility. So in this case, this is a blended example. So it assumes that there's been some dilution at the starting point. So the entrepreneur has 80% ownership. And it uses we're using a 4 times revenue assumption of the value. So in this case, starting point is again 80% ownership with a company valued at $4.8 million. Entrepreneur comes to Lighter Capital, and over the next 2 years takes on 3 rounds of funding, totaling $730,000. We didn't assume any adjustments to the value, and the ownership, as you can see, maintains at that 80% because there's no dilution. And we've assumed a 40% year-over-year growth because in the dollars coming in. In year 2, or it's called year 3, at the year 2 point, they go and raise the Series A at a taking on $3.5 million of equity at the company valued at $9.4 million. The dilution, now they go from an 80% ownership down to a 58% ownership. We fast forward a couple of years and a liquidity event happens, right? So the company now is valued at $20 million. The ownership is still at 58, so the founder's share is $10.9 million. Obviously, they have full control of the business at this point in time. Now, the next example compares it to 100% at the all equity scenario, and Lighter Capital is not in it. So same starting point of $4.8 million value, ownership at 80%. In that 2-year period, they go and raise their Series A. And we were assuming, whereas in the prior scenario, it's a $730,000 raise, we say, look, they're going to go raise they raised $1,450,000 at the same pre-valuation of 4.8. So the ownership percentage is now diluted down from 80% to 61%. But because of the money coming in all up front, we assumed a growth rate of 60% year over year versus 40. And that difference you can see then comes into the Series B in terms of the valuation of 12.3 versus the prior example of 9.4. So in this case, now you've raised the Series B, you've raised the same amount, 3.5 million, but because of the Series A, where you've got diluted down, the entrepreneur got diluted to 61%, they're now in the Series B, right, of the $3.5 million raise, the ownership has gone to 47%. So the entrepreneur has lost control of the business, right? And you fast forward to the future of that company, that exit or the liquidity event, same valuation, but because of the ownership, the founder's share is 9.3 million. So when you compare these out, the Lighter Capital or the blended scenario, the same valuations, the entrepreneur has, from a proceeds perspective, $1.6 million more in proceeds. But equally important is the fact that their ownership percentage is higher. So they actually can dictate more of the terms of the exit or what have you. So again, every scenario is going to be a little bit different, right? There's a lot of assumptions that could be made in terms of growth rates and valuations and everything else. But we've seen this time and time again where if the entrepreneur uses Lighter Capital in these earlier stages, that equity preservation and control preservation is extremely valuable to their business in the long term when they're looking at the exits. So that's kind of the highlight, going through that. Hopefully that was helpful to you in terms of the benefit to each of your companies as you're looking for capital, giving you an alternative from angels and equity and everything else. I think we're really excited about the Intuit, the ecosystem and everything Annie and Alex and David are doing for each of you, and just really looking forward to having more discussions with each of you. All the companies we've talked to have been great, and hope to be a big part of the growth of this ecosystem.
Awesome. Thanks, Alan. We are getting a lot of questions coming in. I think I'll knock out a couple of the easy ones myself first. So yes, we will make this available after the fact, and yes, it'll be the video as well as the slide deck. So if some of you have other members of your company or your board or anybody else that wants us to get this information, that'll be available. And then a question for you, Alan. This came in a lot. There's a lot of people super excited about this. It's great. They're so excited that they're almost a little disappointed because it's only the U.S. So can you speak to Canada, Australia, and some of these developers that are in some of these other regions?
Yeah, and we've had a number of those discussions. I'll say for right now, again, if there's operations in the U.S., we should talk. We can try and figure out, how much we can provide in funding for those U.S. operations based off the revenue in the U.S. operations. We are looking at trying to figure out different ways to go international. For the time being, though, we're really, we've got a huge potential here in the U.S. specifically, and so we've kind of decided to primarily focus there. But it's not lost on us that there are a ton of amazing companies in Canada and in Australia and New Zealand. We see a lot of IP coming out of those areas, Israel as well. So excited about the future potential, but as it relates to now, if there are no revenues coming out in the U.S., we're precluded from providing capital.
Got it. And then one of the questions kind of tailing off of that, do you have connections or can you help assist maybe some companies to set up a U.S. subsidiary or a U.S. bank account?
Yeah, we should talk. We can talk. Absolutely.
Okay. Yeah. That's good to know. And then there's some questions around the payment structure. When does repayment begin? Are there penalties for early repayment? What if the company's sold?
Yeah.
The new owners want to pay it off. Can you speak to some of the repayment situations?
Yeah, great questions. So payments do begin depending upon when the initial funding is. So I'd just say a month or two after. So unlike traditional venture debt, where tends to be a 12 to 18 month window of interest only payments, our facilities do start amortizing out of the gate. But because of the variable nature of those payments, it's a little bit more flexible than a venture debt facility when it starts hitting the P&I collective payment, their principal and interest payment. And then as it relates to, I think let me make a point on that as well, David, that one of the great things about our model is because of how efficient we are and because of the technology behind our business, we really believe in capital optimization, right? So if you go and look for called venture debt or equity, those investors are going to want you to take as much money as possible, right? To be able to, because of the inefficiency in those processes. And so whether the venture debt says, no, you got to take $1 million, and you're saying, I don't need $1 million, I only want $250 for the next year or so. Because of the inefficiencies, they're going to want you to take as much as possible. Whereas Lighter Capital, we are so quick and we can start looking at funding within 3 months of the initial funding round, that you may say, guys, I only need $100,000 today. But I do think over the course of the next year, I'm going to need upwards of $500,000. So you can take that $100,000 day one. It's not a big deal, right? Because within 3 months, you can come back and we can start talking about how much more. When do you need the next round? And when we do that next round, we essentially, as I noted previously, we recapitalize the whole facility, kind of true up the repayment caps, the royalty rates, and everything else. So it could be, our minimum rounds are $50,000. With a maximum per round at 500. So wherever you fit into that, we can work with you. As it relates to the prepayment question, this is where we look a little bit more, like equity than we do traditional bank debt. So traditional bank facilities will tend to have a descending prepayment penalty. Year one, you call it 5%, 4%, 3% as the maturity, as you get closer to the end of maturity of percentage of principal balance. Whereas equity, obviously you sold your 20 or 30% and there's no way to quote unquote get, prepay that, right? That you've sold ownership in the business. We kind of sit in the middle there. So if you came into all of a sudden you decided, you have, your uncle provides you, $500,000 and your Lighter Capital facility is, the total obligation is $300. There's not as necessarily a reduced prepayment kind of structure in that scenario. Where we do we would expect to get the full principal plus the repayment cap. So in our prior example, we would want to see the full $680,000 repaid, because you're not ever required to repay it until it's paid in full. Conversely, though, where we do have early buyout options are as you noted, in the case of an acquisition, or in the case of companies that want to go raise equity. So typically there's a window in those facilities of anywhere from 12 to 18 months, depending upon the term of the facility, where a reduced early buyout amount can occur. And it's really kind of deal to deal. We can, if anybody's interested, we can talk specifics around them. But it allows you for, if there's a qualified event. So again, an acquisition or an equity raise, you can take us out at a lower amount than that initial repayment account.
Got it.
Answer? Was that clear, or did I? That's an important point, David. I just want to make sure that I do answer it.
Yeah, if anybody needs clarification on that, if you need to ask another layer of question, please use the Q&A panel and do that. On the next kind of chunk of questions that we kind of probably could go into are kind of a little bit high level. It's really people trying to understand, is it only SaaS? What if I'm desktop? What if I do Intuit QuickBase? So these types of things. So I probably will just literally kind of read these out, and then we can, kind of hammer these through. So one of the questions is what if they build an app that works with other accounting software packages, not just QuickBooks?
Yep.
Is that okay?
Yep. We're obviously this was a whole, the intent, the fund was for Intuit to really support their developers, but I know that Intuit isn't necessarily naive to the fact that there's multiple developers, right? So we'd be open to talking.
Got it. Another one is what qualifies as a QuickBooks developer. This one maybe is for our side. If you got this email, you're in the Intuit Developer database, so you are a QuickBooks developer. So that would qualify you if you're at this webinar. And then here's another one. This is an interesting one. I'm currently developing a hardware solution. I don't fall under SaaS software or services. Is this a no-go?
I guess I'd want a little more definition of or understanding of what the hardware piece is. In the context of this discussion, that's kind of hard for me to understand if it's like a payment processing, different. I guess I don't really want to speculate on what it would be. If they want to reach out, I'm happy to talk through it quickly.
Shoot an email to you? Okay.
Yeah, not a big deal.
Got it. And then this question's so obviously SaaS companies are a little bit of your sweet spot because they do monthly revenue. Are there any specific industries within SaaS you're specifically focused on?
No. We're pretty. We've got stuff across all. Yeah, I'd say no. We're pretty open to anything within that in the SaaS market.
Got it. And I'm kind of getting down to the last questions here. So if anybody else has additional questions, we do have some time still. Please use the Q&A panel and get those asked. I know there's 75 of you, and there's been a lot of content, so there's got to be some more questions. This is a bit more math. All right, you ready, Alan?
Yep.
Assuming a company is doing $25K a month, MRR.
Yep.
Can you run through the options again?
Sure.
I don't even know if you had a slide on that if you wanted to go back.
Yeah, let me go back up.
So if somebody's doing $25,000 a month MRR.
Yeah, so this is probably kind of the best one of how to look at it. So the earliest, kind of a couple different slides here, but the earliest kind of size company that we can look at is $15K a month. So 25 is in there, and we'd be happy to take a look at that. So at 25 a month, if you look at the principal amount here, is based on a 3 to 4 times monthly revenue. So if we've been seeing a lot more, we've been doing a lot more 3-year facilities, to be fair. So in that case, that would be a 3 times the principal amount, 3 times that monthly amount. So the 25,000 multiplied by 3 would be initial tranche size of $75,000. And it's, what's great about our model is that it doesn't preclude, we can go that early, and it doesn't preclude us from saying we want to work with people, right? We've funded companies, as a great example out of LA, that when they came to us as a relatively young company, they were doing, the maximum amount that we could fund them was $50,000. They took that money and they started pouring it into advertising. And the company has grown nearly 400% in the last 24 months. And we have gone from providing them $50,000 in principal to now I believe we're just north of $1.5 million. So they were able to just really fuel the growth of the company, and they didn't, they were able to say, yeah, we can use this $50,000 and let's just put it towards growth, right? A lot of times a lot of people will say, well, I don't need that. That 75 isn't really going to move the needle, right? Which I completely understand. but it's really important to note that, going back to the whole point of, we're really agnostic to if you want to bring in other sources, right? So if you do have equity investors in there that can provide some more than that 75,000, right? And that's what really needs to move the needle. You can bring us in to augment, either minimize the dilution factor, or bring us in to have another source of capital as the company scales. So hopefully that helps. As it relates to, how does it work? So let's the 70, using the example, going back to the example of the 25K a month. So let's say we lend 75,000, right? And we determine that the repayment cap on that facility is a 1.5x, right? So total repayment amount to Lighter Capital over a 3-year period would be 112,500, 75 of which is principal. The royalty rate, it's hard to get into what the right royalty rate is, because we don't know kind of growth. I don't know year-over-year growth. I don't know what projected growth is, so forth and so on. So it would be one of those things that we can get into and see what the entrepreneur is looking for. And a lot of times we're really flexible in the fact where we might say, okay, that repayment cap is a 1.5x, and the corresponding royalty rate is 7%. The entrepreneur may say, you guys, what's more important to me now is to have a lower payment each month, but in exchange, I'm willing to pay you a little bit more as a whole on the investment, right? And so it's really about just understanding what the entrepreneur is looking for, and how best to help fuel the growth.
Got it. And you guys, pretty much, it sounds like you're willing to listen, willing to possibly work around people, and really help them, be that partner.
Yeah, it's important to note, a lot of deals, outside of the repeat deals, like our fall, kind of refinance, people that are existing customers coming back to us, that's a significant portion. On average, we do about 2 deals per client. So people are using us in the follow-up. Some of those, as I mentioned before, that the company with 1.5 million in principal right now, they did that over 6 rounds of financing. So the point relevant to that, where I was going, is that we do a significant amount of business with companies that we initially said, it's just not the right fit. And here's what we need to fit. Here's what I'd focus on, right? You just need to add a couple of more customers, or your churn is a little bit off. Can you get it dialed in, or whatever it is. When we're looking at the business holistically, we want to continue to do as many deals as possible with the right business companies, right? And so a lot of it is about the investment team and the underwriters working with the prospective clients about, hey, we just need to see these couple of things tweaked. When that happens, come back to us and we'll stay in touch. So it's not a one where, you hear the stories about equity investors. It's kind of a one and done. If you don't wow them on the first time, that there's really you don't get a second bite of the apple. We are absolutely not that way. We want to help be connected to the entrepreneurs and help where we can.
Got it. And so kind of dovetailing off of that, as far as the way your partnership level with the actual app developers, do you do any, I know if I go to VC, the VC is going to be like, hey, hire this guy. This is a good connection for your marketing. Hire this guy to be your chief technology officer. Do you guys partnership and help everybody find talent, or is it pretty much here's the money and you guys aren't really coaching the business or participating at that board or advisory level?
Yeah, we're not. You're correct. Yeah, it's more of a money with where we can help provide content or connections, or if people are looking to go raise equity, we have we have relationships there. If they're they want to get connected, you mentioned kind of getting companies set up. So whether it's getting U.S. bank accounts or contacts from counsel that might be able to help them do that, right? We have those types of connections, but actively sitting on a board and saying here's a person you should talk to. We're not that. We did 100 deals, a little over 100 deals last year, right? Whereas an equity investor will do 8, right? And so ours is much more kind of about money, but adding value where we can, but not that quote unquote strategic, advisory role.
That's clear. This should be an easy, very black and white question. How many months of revenue history are you looking for?
Yeah, great. Good question. So we want to see that a company has been, it's kind of a fine line. I'd say 6 is the minimum. But that being said, typically what we want to see a company that has been at least incorporated and somewhat operational for at least a year, and then with 6 months of operations, and that's when we can start looking at providing capital.
Got it. And the next 4 questions are very, very specific. So obviously, without asking the attendee more questions about their specific situation, but I think it's still important enough to just highlight it, and you can kind of give a general direction of like, yeah, that seems like it's a good fit. Maybe that's not a good fit. So first one here is, I'm a founder of a 40-year-old managed service business that has developed SaaS with QuickBase that we are launching. Do we fall under the purview of your funding?
Yeah, good question. So it would be worth a discussion depending upon how big this service kind of base company is, and that we have worked with a number of companies where they have pivoted from service into that SaaS offering. I would say, as you noted, the nuances is if I can't really speak to, but on a higher level, we have worked with a number of companies that have done that. I would say if the product hasn't been launched yet, that it's probably a little more difficult for us, because we found that, funding company pivots is not necessarily, it hasn't worked for us. So if that pivot has occurred and it's more a matter of needing capital to fuel the marketing or the selling of that SaaS product, then we can always look to the reliance on some of that existing services revenue to provide kind of the get some of that money in based on the service revenue, but then ultimately longer term, it's that SaaS revenue that supports the continued funding.
So that goes back to that graph you had with the timeline. I think if you go back, I don't know if it's 2 slides forward or 2 slides back, but kind of like you're not coming in at the angels rounds. You're really, you're coming in like, hey, you've launched, you have some traction, but you're not ready to go get VC money yet. Like, I think you have a chart that kind of shows where you fit.
Is it? The banks. This one.
That one. Yeah, exactly.
Yeah, totally. Yeah. It's So example, you're absolutely right. I mean, the $15K a month, right? The minimum revenue requirement of $15K a month essentially says we're not funding pre-revenue companies. We're not necessarily going to be seed investors, right? At the idea point. That being said, $15K a month is really early, right? $180,000 a year in revenue is really early by a lot of standards. So, if you've gotten the company off the ground and you just need a little extra capital, we can come in pretty early. So, but yeah, David, we're not pre-revenue.
Got it. All right. So here's another one. Do SaaS software company have to have its current API connection to QuickBooks Online in order to qualify for the financing? What if the API integration is still in progress? So this is an existing app that just hasn't built their QuickBooks integration yet.
Yeah, I think we're open to it. Yeah, okay. I think there hasn't been any discussions with QuickBooks about necessarily excluding those. So yeah.
Got it. So here's one that's, again, we're going to do some math a little bit here. My company has existing business line of credit with our local bank for $50K. Would we be able to roll that in to the amount of financing with you as part of your facility?
Yeah, so we can do it in one of 2 ways. A lot of times with local banks, they took those, obviously the line of credit is for working capital as noted, right? And so that shouldn't be used for growth capital. That being said, we don't necessarily want to prohibit you from having access to that line of credit to handle some of those working capital needs. So yes, we could take out the line of credit and then potentially get you introduced to other institutions that might provide you a line of credit. Whereas if you have a good relationship with that bank, we could always have the discussion about us being subordinated to them. And so you could keep the line of credit in place as well as take on some growth capital from Lighter Capital.
Got it. Another math question here. What about for a tech company with a subscription model for providing development services with MRR of $35K and 70% margins? Would this company be ineligible because it has a services company under the $50K minimum MRR?
No, because it would be, if the $35K is, if I understand it, they have a $35K. If it's all services, then I would say, yeah, it's a little bit small for us. But if in that $35K, there's a component of actual like reoccurring revenue, then we could always look at it. So there's kind of that 15. If it's pure services, we typically want to see it over 50,000. If it's a combination of services and a reoccurring revenue component, then we can you kind of default to that 15,000 minimum for a reoccurring revenue.
Got it. So this is more of an advice based on your situation. So what's your best advice for a company still in that angel rich uncle phase? So earlier onto the left side of your chart that you have on the screen right now, that doesn't really yet meet all the guidelines and the revenue metrics that you require. So what's your advice for people that are kind of not ready for you just yet? Maybe they will be down the road.
Yeah, I mean, I'd have a discussion. Again, we are open to having discussions. We want to be very respectful of the entrepreneur's time. So those discussions are very candid in nature around here's kind of the things that we would say work on, right? So if it's customer concentration, then let's chat about that. If it's churn, if it's gross margin, like obviously gross margin, you're not really going to be able to change. It's kind of the offering, but yeah, if I would just say if you're interested, reach out. Let's have a discussion. We can kind of see where some of those points that would need to fall in line, and then it's. The great thing about our model is it's data driven and it's transparent. So this isn't about us thinking that, trying to assess product market fit and market potential. It's really about, okay, this is the company you've created. What are the little things that need to be tweaked for us to be able to provide capital? So depending upon, again, if you're to the specific question, if it's you're pre-revenue and you're still trying to find some traction, right? And you're still building out the product, I'd say get that product before, spending your precious time talking to us about what you need to do. If you're early in it and you're at 10K a month, right? And you've got five customers, and you're like, all right, what needs to happen, right? Then let's have that discussion.
Got it. So you're well past the startup weekend phase before they can be contacting you. Got it.
Yeah.
Perfect. This is great. It looks like there's no more questions coming in. Again, we will, Annie will get these sent out to everybody. You'll get the slides and you'll get the recording of all of this. Here's one question, another math question just came in really, really fast. We did 150K in the last 12 months. Worth talking?
Yeah, you're right on the edge. Because the other thing I would say is that a lot of times what we'll look at is that the last kind of couple months. So those first couple of months could have been really low, in the 2,000, 3,000, 4,000 a month range. But if the sales engine's really cranking in the last couple of months, you're showing that growth, right? Then I'd say it's worth talking.
Got it. Perfect.
It could be, to be fair, it could be still a little bit early, but at least we can provide you kind of guidance around when we should talk again.
Got it. And then just before we close up, could you go to your last slide so we have your email addresses captured here so everybody can see them again one more time?
Oh, sorry. Got a little quick on it.
Perfect. So hopefully everybody can see Tom's email address and Alan's. And should they email both of you at the same time? Should they just email one of you?
Yeah, I mean, Tom's awesome. He's really run the relationship with Intuit, so he'd be a great one to reach out to if there's any questions that come up that he, needs some assistance on. I'm happy. We sit right next to each other. So
awesome, perfect. Everybody, I think we're gonna wrap this up. Thank you for attending. Lighter Capital, Tom, Alan, thank you very much. Annie, thanks for pulling this together. And that's it. We'll call it a day. Thanks, everybody.
All right. Thanks, you guys. Appreciate it. Taking time.